Now, understanding the manifestation or the way in which credit risk creeps into the overall lending business. Now, for a bank, credit risk would come in a variety of ways. So, firstly, it is uncertainty related to the repayment of loan by a borrower in an agreed time frame. Now, as we know, whenever a bank does any kind of a lending operation to a borrower, there will be a certain loan schedule which will be agreed by the two parties, the bank and the borrower, and the borrower is expected to make payments as per the schedule. Now, if the borrower is unable to make payments, so either partly or completely, then that is something which exposes banks to uncertainty. Because if the borrower says, if there is unwillingness or maybe inability on the borrower's part to repay the loan, then that's a problem for the bank. And that brings in the kind of uncertainty which we say. So whenever we have any kind of lending operation and a bank has lent money to a borrower, there will always be certain uncertainty as to how the borrower or whether the borrower is going to make a repayment on time or not. There are also uncertainties related to counterparties who do not agree to certain pre-agreed conditions. So, for example, think of an OTC derivative. Now, for exchange traded derivatives, this is not much of a problem because for exchange traded derivatives, we know that a CCP is going to step in and they are going to make good any kind of losses which the bank may be exposed to because the counterparty is not honoring their obligations. However, if it's a OTC transaction, i.e., think of this as a bilateral transaction between a bank and its counterparty. Now, if the counterparty is not honoring its agreement, or basically it is not satisfying their side of the bargain, then that is another kind of uncertainty which brings in credit risk for the bank. Thirdly, there can be deterioration in credit quality of the borrower. We can think of this as credit migration. Put very, very simply, we can think of credit quality deterioration as maybe a change in rating. So let's say, so think from an external ratings perspective. So imagine that when the bank had done a lending operation to a certain party, a certain borrower, let's say the party was rated double A. Now, over time, let's say the rating of that party has dropped to, let's say, A. Now, this is a deterioration in the credit quality because the credit rating initially was double A, which has now dropped to A. And it is because of this reason that this drop in rating is going to expose bank to a higher credit risk because now the perceived risk of default, which is associated with this particular borrower, has gone up. And that is reflected through this credit migration or drop in rating. So this is another form in which a credit risk can manifest itself for a bank. Now, banks will bifurcate credit risk in the form of expected losses and unexpected losses. Now, when you say expected losses, you can think of this as those kind of losses which the bank can fairly estimate with some degree of confidence. So EL, so many times expected loss is also called as EL, as we'll see in our subsequent slides as well. So for EL calculations, banks are going to use their historical experience and know-how as well, because this is something which the bank can use their historical data in order to come out with. And that way, expected losses can be like a decent enough estimation which the bank will try to do. However, unexpected losses, as the name goes, these are naturally something which cannot be predicted. So it is the unexpected losses which brings in a lot of challenge when it comes to a bank as to how much amount of capital which it needs to put aside in order to take care of any kind of unforeseen losses which they'll be exposed to. Now, we will see more on EL, and unexpected loss is also called as UL. So we'll be calling it as EL and UL in our subsequent slides as well. Now, if the bank's expected loss is exactly equal to the actual loss, then there is no credit risk for the bank. Because the thing is, credit risk is going to emerge whenever there is any kind of unexpected loss which the bank is expecting. Because if it's an expected loss, that is something which the bank can completely factor into their product pricing. That is, whenever they're making any kind of lendings to businesses or whenever they're accepting any kind of borrowings, they can manage the interest rates at which they do this transaction. And that is what we call as pricing in this risk. So expected losses can be factored in through product pricing. However, unexpected losses is something which which cannot be done this way, because by the very definition, unexpected losses is something which the bank also doesn't know with certainty. So if they don't know with certainty, how exactly are they expected to factor that in, isn't it? So that is something which we cannot tackle through adjusting of the pricing of products. So that can't be done. So for that purpose, we require the idea of economic capital. Yeah. So due to the nature of the lending business, it is not possible for expected losses to capture all aspects. So as we saw, the manifestation of credit risk. So one can also view as a relation between EL and UL in the form of a distribution. So one can think that expected losses is like a mean of your distribution, whereas unexpected losses is like a variance or standard deviation of losses. So imagine you have a loss distribution. So expected losses can be thought of as a mean of that particular distribution, whereas any kind of deviations away from this mean is something which we can classify or we can call as an unexpected loss. And this is where the idea of economic capital comes in big time. So economic capital is defined as the amount of risk capital that a bank would estimate in order to remain solvent at a given confidence level and over a certain time horizon. So it's not like this is going to be there till eternity, because credit risk management, so generally the time horizon which the bank will look at could be, let's say, 1 year. And also there will be a certain confidence level, because there is something which we call as the idea of a capital multiplier, which we'll talk about in a bit. Now, that is something which gets associated with the confidence level as well. So, more about this coming up. So, for now, just remember that economic capital will be the amount of risk capital which the bank will estimate for a given confidence level and a certain time horizon. So, a similar chart like earlier one has been drawn below. Again, we have given a nomenclature. Only thing is we have just reduced the number of sections which were shown. So, we had right from A through to F. So now here we have just trimmed them down, because for this particular discussion, these three sections are good enough. So other things like expected losses, returns, they remain similar. Shareholders, junior uninsured and senior uninsured creditors, and these are the things which we'll use as a part of our current discussion. So that's why we have just highlighted them here. And if you observe, earlier we were talking from risk capital in general. Now we are focusing on the idea of economic capital in particular. Because as I mentioned, the idea of confidence interval, right, or the confidence level, that is something which gets related with this idea of showing economic capital. And that's why it has been depicted in this way. So let's try to understand what this chart means. So to interpret the above chart in simple words, now a bank will remain solvent even if the equity value falls below its liabilities, and also when they default on junior or subordinated debt. Now, as we know from the capital structure theory, equity holders have the lowest priority. So that way, any kind of losses is something which can hit the equity holders first. Then it will be the junior debt holders and the junior or the subordinated debt, as we call it. So bank will continue to remain solvent even after the equity value falls below liabilities and when they default on these two items, either junior or subordinated debt. Now, one critical point or a critical threshold, as we call it, is hit whenever the bank defaults on its senior debt. Now, this becomes a big problem for the bank. So that's why if you see in the diagram, we are focusing on the senior debt idea here. This is shown by the shaded section in orange as well. That is because if the bank is unable to service its senior debt, then that means the bank is running into trouble and bank doesn't have required amount of cash or required amount of funds in order to make repayments, i.e. the bank is unable to support the kind of leverage which it has taken on its capital structure. So that's why whenever bank defaults on its senior debt payments, we call it as a critical threshold has been hit or has been breached. So if this critical threshold is hit, then the result is the credit rating of the bank may be downgraded naturally, because if the bank runs into trouble and it's unable to meet the requirements of its stakeholders, then its credit rating will be jeopardized. So we can expect a downgrade in the rating. This may also result in an increased perceived risk in the minds of stakeholders. So so be it investors or be it even customers, they may become pretty wary of the bank. They may feel, I mean, this bank is running into trouble and they might want to withdraw funds. So this can also result in the problem of run on the bank. And if this happens, naturally the bank is going to lose deposits left, right, and center, and that is going to make it very difficult for the bank to continue its operations smoothly. So that's why every bank will try and ensure that they don't hit this critical threshold. So therefore, the minimum capital required by the bank to hold on to a specific credit rating of senior debt is the economic capital. So they need to ensure that their senior debt remains intact. They don't make any kind of defaults. That being said, it does not mean that the bank should default on junior or subordinated debt, because ideally the thing is, if bank is able to service all of these debts, then naturally that is something which puts a very positive perception in the minds of the market and the customer, which is very important for the bank from reputation building and also from getting new businesses. So every bank will ensure that they don't default on these commitments, so that not just their credit rating remains intact, but they also remain like a trusted name in the market, which people will be willing to do business with.